let's get into Unit 18. And this is about taxes and how they affect real estate. Okay, now on Unit 18, we're going to have 3% of the questions. So you're going to have 3 questions of 100 on this section. Okay. And if you notice, we have a ton of slides, right? It's a very in-depth section you need to know. However, you're only questioned on 3% of it, right? So I'm going to point some of that stuff out to you. So you have city and county property taxes. Okay. So real property taxation process, how it works. Okay. So you have ad valorem taxes. These are based according to the value. They're levied on a calendar year basis and they're paid in arrears at the end of the tax year. Remember we talked about that before? You live and then your taxes are paid.
Yep.
So taxes become a lien on real estate on January 1st for the preceding year. The lien is legally superior to any other lien, regardless of date. The taxes are superior before the mortgage. You don't pay your taxes, they'll take your house, right? They'll take your property. Okay, if you have a mortgage or not, they'll take it. Taxes are due on or after November 1st each year. Taxes for the previous year become delinquent on April 1st. Okay, so they become due November for this year. For last November this year, they'll become due. They're not liened until January 1st. So you can pay it between November and January. They usually give you a discount. And if you let it go from January, they put a lien. Now it doesn't mean anything. The lien's there. And then you have till April to pay it. So once you pay it, the lien goes away. Now, if you don't pay it by April 1st, now you're delinquent. Okay. And your taxes are late. And then there's fines and things. So when they're calculating the taxes, there's something called the just value. And that's an objective valuation. Okay. And to get that valuation, they come up with an assessed value. And this is established for tax purposes. Okay. And every year in November, you get a notice of proposed property taxes. It's called a trim notice. So every year when you get your bill, it's called a trim notice. And it says what's due, when it's due, when you pay it, and everything. So when you get your trim notice, if you don't agree with it, a lot of people are arguing on them right now because they're trying to like raise them and different things. You have a protest procedure. And the protest procedure, the first thing you do is you contact the county appraiser's office. You appeal to the value adjustment board. Now that board is made up of 2 county commissioners, 1 school board member, and 2 citizens of the county. And there's litigation. You basically file suit against a property appraiser and tax collector. You actually file a suit in court. Okay, so to remember the 3-step process thing, ABC, appraiser's office, board of adjustment, court process. Okay. Now let's talk about tax districts, budgets, and tax levy. City, county, and school board budgets prepared for each fiscal year. So the city and the county, they prepare their budgets for that year. The property taxes are used to pay the majority of budgeted local services. And you also have special tax districts, which will include fire control, water management, flood control. Okay, they use budgets to estimate the expenses and revenue requirements for that year. So let's talk about exemptions from property tax. Okay. There's immune properties, there's exempt properties, and there's partially exempt properties. So an immune property would be government properties. They're not taxed at all. They don't even get a bill. They're just not taxed. Exempt properties would be like nonprofit organizations. They own and operate real estate for religious and charitable purposes. They're subject to taxation, but they're released from the taxes. So they'll get a tax bill, but then they release it. So they get billed and then it's released. And then there's partially exempt properties that are taxed only on a part of the assessed value. Okay. So partially taxed properties would be something like a homestead, where they take credits off and you get discounts for it being your homestead. We talked a little bit about this earlier. So let's talk about the homestead exemption and how this works and how it operates and how you calculate it. You need to know this for the test. You will have calculations on this. Okay. So to qualify for a homestead exemption, the person or people must be permanent residents in Florida, and they can only claim one homestead. They have to hold title to the Florida residence in their name. It can't be in a company or an LLC. It has to be in their name. Okay, they must own the title as of January 1st. They must hold the title and reside in the home. Okay, so for the first year to get the homestead, they have to file with the county appraiser on or before March 1st. So basically, anybody who closes their property in 2023 before the end of the year would have to apply for homestead before March 1st, 2024. If you close your property January 1st or anytime after that in 2024, you have to wait till 2025 between January 1st and March 1st. Or you have to wait till the next year. There's only certain times you can do it. Does that make sense?
Yeah.
So let's talk about calculating the taxable value. Okay, it's determined by subtracting all applicable exemptions from the assessed value. So the assessed value of $25,000 to $50,000 will get a base homestead exemption of $25,000. Now, do you know of any houses that are assessed at $50,000? I mean, does it even exist anymore? Like at that level? I mean, I don't think there's any property that you can live in that's a house that can be that, but there's different levels, and I'm going to explain that to you.
Yeah.
Okay, the base homestead exemption is $25,000. And that is broken down into two separate calculations. And I'm going to break these down for you and show you charts. Don't worry. You have city, county, and school property taxes. Okay, so there are two separate calculations. The city and county are one calculation, and the school board is another calculation. So there's two separate breakdowns. And here's how it works. If a property is assessed under $25,000, I don't know if any of those exist, you're able to get $25,000 exemption, $25,000 exemption, $25,000 exemption. So you can get it up to the value. Okay, so you could possibly pay no taxes. Now, if the property value is 25 to 50, you get the 25, 25, and 25. That's the base, right? All the way across. Now, if the property is 50,000 to 75,000, you get the base 25 plus any prorated additional exemptions. We're going to talk about that in a minute. In the county, you get the base 25 and any prorated additional exemptions. And the school board, you only get 25. The school board benefit taps out at 25,000. You can never get more than a $25,000 credit on school taxes. Okay, you got that?
Got it.
So school taxes are 25 all the way down, no matter what. You can't get any more than that automatically. Now, if the property is over 75,000, and this is like everything, really. I mean, very few things are here. So over 75,000, as long as it assessed over 75,000, you get the base 25 and an additional 25 exemption for city, the base 25 and an additional 25 for county. And remember, school is base 25,000 only. Can't be more than that, right? On these exemptions for homestead. So if anything's over 75,000, it's 50, 50, 25, right? Okay. So let's look at this here. Taxable value formula for properties with an assessed value exceeding $75,000. Okay. The assessed value minus 25,000 base exemption equals the taxable value for the school board, right? Because you can only take 25,000. Now, the assessed value minus the 25,000 base exemption and the 25,000 additional exemption equals the taxable value for the city and county, right? And the assessed value minus 50,000 exemption is taxable value for the city and county. Okay. They only added city to county taxes in this calculation. Okay. They just, instead of having it complicated, they just put it together because it's the same calculation, right? So you don't have to subtract it twice. That's the breakdown. But literally, you take the value minus 50, and that gives you your city and county tax number. You don't have to do it twice. Does that make sense?
Yeah.
So really, you have this calculation and this calculation for purposes. So let's look at this example. Taxable value for the property exceeding 75,000. Now, when I had my exams, for all my exams, I've never had anything under 75,000. I've never had anything like that happen. So normally you're going to see over 75,000, just so you know. So the assessed value of a homesteaded property is 280,000. What is the taxable value for the city and county? What is the taxable value for the school taxes? You want to calculate those quick?
I would actually rather you do those because I'm still grasping into the ideas.
Let's remember when you're over 75,000, how much do you get off the city and county?
50.
Right, 25 and 25, right?
Yep.
So that would make it 230, right?
Yes.
And what is the amount for school taxes always?
25.
So that would make it what?
205.
255. Two calculations.
Gotcha. Yeah.
Yeah, you don't take it off. You don't take it off the other, right? It's two separate calculations, right? So step one, 280 minus 25 base minus 25 additional equals 230. There it is. That's your number for city and county. And then step two is 280 minus 25,000 is 255 for school board. Okay. That would be the assessed value. That's not your taxes. That's the value your taxes are going to be based off of. We're going to do that in a minute.
That's what I thought I was going to have to do. And I'm like,
right.
I didn't know that.
The first step to it is this, because you got if there's no homestead, it's 280 and 280. And then you just figure the taxes. But if it's homesteaded, you have the 50 and the 25 that come off, right?
Yeah, makes sense.
Okay. Now, there are additional exemptions. Okay. As of January 2023, the exemptions are 5,000, not 500. Okay. Before this year, it was 500 extra. So don't worry about 500 extra. Okay. If you see any of these exemptions, they're $5,000 each. So if there's a surviving spouse, which is a widow or widower who is not remarried, they get an additional 5,000. If they're legally blind, they get an additional 5,000. If they're a non-veteran who are totally and permanently disabled, they get 5,000 in addition, right? So they get, if it's 75,000 and over, city and county, they get 50,000. And if they're a surviving spouse, they get an extra 5. And if they're non-veteran, extra 5. If they're all 3, they get 15. Okay. And that's on school taxes and city and county, on both, right? School's the maximum 25, but then they still get these taken off too. Now let's look. There are other exemptions. 100% homestead tax exempt. These people do not pay property taxes. They're exempt. If you're totally and permanently disabled, quadriplegic, if you're paralyzed from the waist, from the neck down, right? You don't pay property taxes. If you're a totally and permanently disabled first responder, police, fire, emergency, if you become disabled, and it also applies to a surviving spouse. If they die and there's a surviving spouse, they do not pay property taxes. They have a homestead exemption if they get this. They're waived. Okay. So remember, 5,000 for these, waived for these. Now, There's also additional exemptions for disabled veterans. If a veteran is at least 10% disability by military service connected misfortune, they get an additional $5,000 exemption from the Homestead property. Okay. And also, there's 100% homestead exemption. This means these people would not pay taxes. They're waived. If they're service connected, total disabled veteran, so if they have 100% disability from the VA, or they die, it includes a surviving spouse, 100% exemption. And also the surviving spouse of veterans who died while on active duty. So if they died in active duty, their spouse has 100% homestead exemption. Okay. So remember, 5,000 for surviving spouse of a widower, legally blind, non-veterans who were not permanently disabled, right? Non-veterans who were totally and permanently disabled. 5,000 for those. 100% if permanently disabled quadriplegic, or totally and permanently disabled first responder, also surviving spouse. 10% if you're under 100%. If you're at least 10%, but under 100%, you get 5,000 exemption. 100% disabled gets full exemption. And the spouse as well, right?
Got it.
So let's look at the cumulative homestead exemptions. Let's do an example. You have the taxable value is determined by totaling all the tax exemptions that apply to deducting from the assessed value. So a homestead single family residence for a legally blind widower has an assessed value of $328. What is the taxable value of this property for 2023? What do you think it is?
Let me see.
Oh, you're muted. You're muted, buddy. I can't hear you.
Yeah, that's okay. That's okay. That's okay. I'm doing the calculations.
It's okay. I thought you were talking. I couldn't tell.
No worries. So I need to find it for both the school and the county, right?
Correct. Yep.
Okay. Okay. So I came up with 268,000 for county and 293,000 for school.
268 for county. 293 for school, right?
Yep.
You got it. Right. So it was 25 minus 5 minus 5. Right. And it was 328 minus 50 minus 5 minus 5. 268. You got it. Good.
Thank you.
Now that we got that, let's get a little more complicated.
Love it.
So let's talk about the tax rates. Now, the tax rates are different for every city, county, right? We're just going to use these numbers. it'll tell you if you get a problem on this, which you will, it'll say the city mills are this, the county mills are this, the school mills are this. They're never always these numbers. Those numbers will change as per county, as per school, right? Because their budgets and they have different calculations. So tax rates are expressed in mills. A mill is a 1,000th of a dollar or 1/10 of a cent, 0.001. Okay. So for example, 10 mil cap, city, county, or school board. Okay. For example, the city is 6 mils or 0.006. Okay. The county is 8.5 mils or 0.0085. And the school is 5.9 mils or 0.0059. So if they tell you it's 6 mils, you got to move the decimal point when you're calculating 3 points, right? You always got to move it 3 points because it's mils. So if it's 8.5, you go 1, 2, 3, 0.0085, right? So that's how you got to do for the math calculations. Always 3 to the left. So let's look at a calculation. The annual property taxes, tax formula. The taxable value times the tax rate equals the annual property taxes due. So an example, a homesteaded property has an assessed value of $280,000. The millage rate for the city is 6 mils. The county is 8.5 mils. And the school is 5.9 mils. Calculate the annual property taxes. So what you have to do is you got to figure out the school taxes. You got to figure out the county and city taxes. Then you find out that number, those numbers. Then you multiply them by the mills, and it will tell you what the amount of taxes are. Does that make sense? Are you frozen up? Are you there? I can't hear you. You're muted.
Looks like it's frozen.
Yeah, he's frozen up. Okay, give me the totals. Don't give me the breakdown. Just give me the total. What'd you have for school and what'd you have for city and county?
Okay, so for city, I have 1380. For county, I have 1955. For school, I have 1504 with 5 cents.
Okay, you got the school. Add the city and county together. What's the total?
The city and
Wait, what'd you say it was? 3335 and 1504? 50?
So for school, I do have the 1504. Yes.
1504.50. What'd you have for county?
For county, I have 1955 for some reasons.
Okay.
Yeah. And then for city, I have 1380.
13. No. Okay. Well, add them together. What does that add up to? 1380 and add that up. 1380.
That's right what it is. Let me see.
Yeah, because in the calculation, I'm going to show you, you do them together. You add the mills together. But what'd you get? I'm just curious. Was it?
Oh, yeah. So, yeah. 3335. I was wondering.
Right.
Did I do
So
something
you
wrong?
got it right, but you did it separately. So let me show you a quicker way to do it. You can do it that way. You're fine. You're still good because the total still adds up to 4839.50. You got it right.
Yeah.
So the solution, okay? You have $280,000. Assessed value minus 50,000 exemption is 230 taxable income for the city and county. Okay. Now city and county are together, right? So you can take the mills, the 6 and the 8.5 and add them together. It's 14.5. Then move the decimal 3 places. 1, 2, 3. 0.0145. So you, instead of doing separate calculations, you can do 230 by 0.0145 and it gives you 3335. So what you did was you did them separate. You could put them together for city and county, right? Now, then that's the first part of the problem. So you did it right. You just did an extra step. That's all. And it's okay to do that. However you feel more comfortable with it. Then you have 280 minus 25 for the school, right? 255. 255 is the it's the 5 point where is it here? The 5.9, right? For the school. So you go 0.0059, 1504.50. You add those together. 4839 is your annual. right? So they're asking you for the annual. You got to add it all together.
Okay.
Okay. They may put in the answer 3335. They may put 50, like to try to mess with you. But annual is, they may ask you the problem and say, what are the school taxes? Then you just got to put the school taxes. You got to be very careful how you read it. Okay.
Gotcha. So if they just ask for the annual taxes, that means
Everything added together.
the three of them together. Okay.
Yep. Yep. Very good. You did a good job on that. Very good first time.
Thank you.
Okay, so let's look at some of the facts about calculating property taxes. The homestead exemptions are deductible from the assessed value to find the taxable value. The base 25,000 exemption is subtracted to calculate school board taxes. A non-homesteaded property, the assessed valuable is the taxable value, like we just talked about. So if it's 280 non-homesteaded, you just multiply by that. You could see something like that too. The taxable value is multiplied by the tax rate in mils, right? You got to move the decimal point 3 to determine the property taxes. Okay. Save our homes and portability. Okay. There's caps on assessed values of the homestead property may be increased per year. So they cap how much it can go up when you're homesteaded. The just value for homestead may be increased by lesser of the two, 3% annually or the CPI index. Okay. The save our home benefit is the difference between the assessed value and the market value. So if it's the market value is 400,000, the assessed value is 310, the save our home would be 90,000, right? I'm just using an example, right? So what this is, a homeowner may transfer up to 500,000 of save our home benefit within 3 tax years of last qualified homestead exemption. So if your homestead is exempt right now, you have an extension, and let's say you have $120,000 difference. Say it's 500,000 value, and it's 380. You're assessed, right? So you have $120,000 difference there, right? You can sell that house, and within 3 years buy a new one, and they'll give you that same $120,000 less. But if you wait more than 3 years, you don't get it. So it allows you to take that savings to your new home, and you have 3 years to do it. Okay. Does that make sense?
Yeah, it makes sense.
You just got to know this. I've never been questioned on this.
All right.
Anything you need to know on this, just know 500,000 in 3 years, I would think. But I've never, and 3% most, right? Now let's talk about discussing taxes with buyers. Okay, a homestead property is sold and it is assessed at the just value as of January 1st of the sale year. That sale will trigger a new assessment. So the assessed value may significantly increase after change of ownership. So if you buy a house and it's assessed at 390 and you buy it for 500,000, they're going to come out and reassess it. Your taxes are not going to be the same as the sellers. So you can't tell them the seller's paying $3,500 a year in taxes. That's what yours will be. You can't do that. It's not true. Right? So you have a disclosure summary regarding property taxes. You got to refer the buyer to the county property office, tax office. Online, they can put in there, I'm buying a house for this much. Here's the county, here's where it is, here's the city, and it tells them what their taxes will be. Rule of thumb is about 1.8% of the sale price is rule of thumb. But you can't quote that 100%. You can tell them estimate, but they have to go to tax. You got to tell them to do it. Okay. You can show them where it is and do it. It's right there as a calculator. You go in there, you put what you're buying it for, you put where it is, boom, it tells them. Okay. Now you also have a law called the Florida Greenbelt Law. Okay. Remember we talked about highest and best use? So if you have a huge piece of land with cows on it, it's worth what it's worth with the cows on it, right? Obviously, if you develop that land and put 150 houses on it, it'd be worth a lot more, right? Okay, well, there's something in Florida called the Greenbelt Law, and it allows property appraisers to assess agriculture land based on the current character and use. So if it's a big plot of land with cows on it, they're not going to appraise it for highest and best use. Okay. The assessment is based on the current use, not based on the highest and best use. It protects farmers from high taxes because land may be suitable for commercial development. So if they estimated that for development, you know, they would put the farmers out of business because they couldn't afford the taxes, right? It requires annual classification as agriculture. They got to refile every year to be classified as agriculture. Because when you're agriculture, you pay less taxes. You know, we sold a horse farm. It was 10.5 acres. That property should have been 15, 20,000 a year in taxes. It was 3,500 because it was agriculture, because they had animals on it, horses. You know, the people who bought it were putting fruit trees and keeping horses on it. So as long as you keep it agriculture, you get that benefit. Okay. That's the Florida Greenbelt law. Now you also have special assessments. You'll see a question on this 100%. Okay. Special assessments are one-time taxes for public improvement that benefits the property owner. An example would be street paving, sewer lines. Okay, it's a specific superior lien. It'll be a lien on the property. It's not an ad valorem tax. So it's not on your taxes, it's a lien. And it's levied on a front foot basis for street paving and per hookup basis for sewer lines. Every test I took had the one on the street paving. Special assessment calculation. You got to take the lot dimensions written with the front footage first, then the depth of the lot. You have to calculate front feet times cost per linear foot equals the total paving cost. The total paving cost times the property owner's responsibility. The proper owner's responsibility divided by two sides of the street. Okay. So here's an example. A lot measures 120 feet by 325 feet. The local government will pay 33% of the total cost, $25 per front foot to pave the road. And then they ask you to calculate it. So here's how it works. Remember, it's only by front feet, right? So when you look at this, the lot measures 120 by 325. You can cross off the 325. It doesn't matter. You're not paving the backyard, right? If you're 325 is how far back it goes. We want to know how far forward, like along the street it goes, right? So 120 is along the street, 325 is the backyard. If you were paving the backyard, it'd be that, right? So you worry about this. It says the local government will pay 33% of the cost. So what you do is you take 100% minus 33%, and it leaves you 67%. You take 120 feet by 25 feet per dollars per foot is $3,000. That $3,000 times 60.67, right, is 67%, is what the property owner's share is, right? 2010. However, there's two sides of the street, right? So they each pay half. So you divide it by 2, and there's your answer, 1,005. On your test, this answer will be there too. Okay. You always got to remember that divided by 2 at the end. Okay. Does that make sense?
Yeah, it makes sense.
You got to know how to do that one.
Got it.
Okay. Non-payment of real property taxes. Okay. Property tax lien is superior to all their liens on real property. If you don't pay your taxes, it goes to tax auction. A tax certificate is issued. Okay, there's a bid. They can get up to 18%. So if they bid that and you pay your taxes late, you got to pay that fee. The property owner pays the taxes plus the accrued interest. They get a redemption of certificate. So once they pay it, that certificate goes away. That's the tax deed process. Okay. So if you don't pay your taxes, it goes to auction. You don't pay it for a certain amount of time, they can take your house. Okay. Let's look at the federal tax benefits or for principal residences. So these are benefits for a house that you live in, not invest in, live in. There's deductions that the taxpayers itemize. So if you itemize your taxes, you can write off all your mortgage interest on the principal home and a second home, not an investment property, a principal home. And if you have a second home, vacation home, you can write off the property taxes on the principal home and the second home. First-time home buyers can withdraw money from their IRA penalty-free. There's an exclusion on gain from sale. Okay, so if you sell the property you live in, if you're single, you can make $250,000 without capital gains, and if you're married, you can make $500,000 without capital gains. If it's an investment property, you got to pay capital gains on $1, right? So when you live in it, it's $250 single, $500 married, that you don't pay any capital gains on. Okay.
Got it.
Let's look at the additional tax benefits. Okay, you have interest on home equity loan deductible, provided the loan is used for home improvements. Mortgage origination and discount points. If you're buying a home, all your points in origination is deductible in the year paid. If you're refinancing a home, it's deducted over the life of the loan. You got to know the difference. You buy it, you can write that whole amount off the year you buy it. If you're refinancing, you're paying points. It's deducted, divided by how many years the loan is. Okay?
Interesting.
Yep. It's pointless, actually. You pay $5,000 for points divided by 30 years. It's like nothing. But that's just the way it works. Let's talk about the sale of real property. Capital gain is the profit from a sale of real property. A taxable gain is determined by the amount realized from the sale. That's the sale price less expenses of the sale. That would be your commissions, anything you did, right? That you don't have to, like, if you make 100,000, you pay 10,000 in commissions, it's 90,000, right? Like anything like that. You have your adjusted base. Okay, so the basis, the adjusted basis, you take the owner's original cost. That's the basis, right? What your original cost was. Say you bought it for 50,000, you put 50,000 in to fix it. You sold it for 150,000. So the 50 and the 50 is 100, right? That's your adjusted base. The 50, then you sold it for 150, you made 50,000 profit, right? That's how that works, adjusted base. So you have your original cost plus expenses of the purchase, any point, anything that you paid. Say you paid a commission on the buy side, that would be there, and any improvements, any capital improvements that you put a new roof, put windows, all that, right? That would be your adjusted base, your original cost plus all the other money. And the capital gain is the amount realized less the adjustable basis. So you sold it for 150, you bought it for 50, adjustable basis is 50, you made 50. That's your capital gain, right? If you lost 50, that'd be a capital loss, right? Now let's talk about sale of property by foreign sellers. There's something called FIRPTA. It's the Foreign Investment in Real Property Tax Act, income withholding tax. Okay. It aims to prevent foreign sellers from avoiding paying taxes. The title company must withhold 15% of the amount of the realized profit on the sale. Okay, the property is exempt if the amount realized is not greater than 300,000. Buyers and sellers should consult IRS or tax specialists. If somebody's a foreign buyer or seller, you have to fill out, or foreign seller, I'm sorry, not buyer. There's a FIRPTA form and you have to check it off on the contract. And the title company is required by law. If they make over 300,000, they got to hold 15%, because a foreign person can take that money and leave and never come back. And they don't have to pay taxes. But they really do, right? Because they made the money here. Okay. So that's FIRPTA. Let's talk about investment property. Now, remember we talked about effective gross, remember NOI, PGI, right? We talked about that already. This is going to go a little more detail. So the types of income on investment property is the effective gross income and the net operating income, right? Remember, effective gross income is the potential gross income. That's the most you can make, right? If everything was rented. No lates, nothing. Minus vacancy and collection losses. And then you would add in any other income. That would be the vending machines, the washer dryer, that kind of stuff, right?
Yep.
Okay, good. Now, once you have the effective gross income, you take the net operating income minus the effective gross income, and that gives you your operating, or I'm sorry, to get the net operating income, you take the effective gross income minus the operating expenses we talked about, right? And that gives you the net operating income. That's the profit on that, okay? Are you clear on that?
Yeah. Yeah.
Now let's look at the deductions from gross income for investment properties. Remember, you have operating expenses. That's your replacement expenses, but not reserves, right? That wouldn't be the money you're putting away for the roof, right? Financing expenses would be a mortgage interest. Okay. You could write your mortgage interest off, not your payment. You need to know that. You may see questions on that. You can write mortgage interest, not mortgage payment. Does that make sense?
Yeah, it makes sense.
Okay. And depreciation is a deduction of cost of improvements. Okay. So there's depreciation that comes off per year on buildings. You need to know this. Good chance of a question. So how do you do depreciation for income taxes? This is for income property, not the home you live in, only investment property, right? There's a depreciable basis, and you have to remember land is never depreciated. Okay, never. There's straight line depreciation, and you have to remember these years. Okay, so it's 27 and a half years for residential rental property. That includes single family homes, condominiums, and apartments and townhomes. And 39 years for non-residential income producing property. That's industrial and commercial investment property. That's the depreciation terms. 27 and a half for residential, 39 and a half for anything that's industrial and commercial, right? So let's look at the formula. You take the total cost to acquire the property, subtract the value of the land, and that gives you your depreciable basis. That depreciable basis is divided by the useful life. 27 and a half if it's residential, 39 years if it's annual or industrial and commercial. The annual IRS depreciation deduction is what that equals. So you could take that much money off your tax income every year. Okay. Now, on the practice exam, you're going to have a question like this. You very, very much likely will have a question like this on the test. So the question could be, the property is worth $1 million. The land is worth $200,000. It's an industrial warehouse, right? It'll be something like that. So the property is $1 million. The value of the land is 200. The depreciable base is 800,000, right? You take the 800,000 divided by 39, and that'll be your depreciable basis per year. That would be your answer for that, whatever that number is. Okay?
Got it.
If it was a residential condominium unit and the same numbers, you would divide it by 27 and a half instead of 39, right? That's the only difference. Right?
Yep.
So that's how that looks. Now let's look at capital gains and losses. A sale of capital assets. Okay, if it's sold for more than its basis, it's a capital gain. If it's sold for less than its basis, it's a capital loss. Capital losses can be used to offset capital gains for tax purposes. Loss on the sale of a principal residence is not a capital loss. It can't be your home. It has to be investment property. You know, sometimes people sell property at a loss for a reason, so they don't pay taxes. They do that.
Yeah.
Okay. So loss on the sale of principal residence is not included. Remember that. Never a house you live in. Okay, capital gains are taxed at the applicable capital gains tax rate. Whatever it is, that's what it's taxed at. Okay. Now let's look at the installment sale method. Okay. This is when a gain is received over a number of years. A seller pays capital gains as the gain is received. Capital loss must be reported in the year of the sale. So if they lose money, it has to all be reported that year. If they're making money and they're making money over the years, as they're making the money, they report the capital gains. So sometimes you'll see a seller finance the property, right? And they're financing the property because they would have to make capital gains if they sold it. So they'll finance it and just make capital gains on the income per year instead of paying on the whole thing.
Yeah.
That's called the installment sale method. Okay.
Installment sale method.
Yep. And last but not least, like kind exchange. This is the 1031 exchange. What you need to know for the test is just this. It's real property for real property. It's section 1031 of the tax code. Any personal property or money exchanged to even out the values is called the boot. You got to remember that boot. If there's anything that's left over, if there's anything that isn't exactly traded, say there, is $1 million in deals, but there was $100,000 left over that wasn't in it. They would have to pay capital gains on that as a receiver. That's called the boot. They got the boot. They pay your tax, right? Remember that. You might see something on that. Okay. And that's the end of the chapter, unit 18,